Hello, Culture Matters podcast. Boy, am I excited about our episode today with my co-host Aleck Arena and our guest, who I'll introduce you in a second. Or we'll introduce you in a second. Here's a quote just for this episode. Successful investors tend to be unemotional, allowing the greed and fear of others to play into their hands. Seth A. Klarman. Shout out to our last episode together with our guest, Luke Winchester from season 47, episode 557. Go listen to that episode if you haven't listened to it and you're listening to us today after this episode. Our co-host today, I just want to reintroduce Aleck Arena, great friend of the Culture Matters podcast, who brought a wonderful guest, Luke Winchester of Meriwether Capital, into our lives, to the Culture Matters podcast family. Aleck, I know you want to give a little, in America, we call it a livegy when there's a living person's eulogy. So if you want to give a little livegy for our friend Luke in honor of
Uh,
him taking his time
sh-
today.
Sure, I can totally do that for Luke. So Luke runs a small. Sorry, this is quite funny. Um, Luke runs a. I've never thought I'd be introducing Luke. So he runs a small cap fund, yeah, up in Newcastle, New South Wales. And pretty much focuses on Australian small caps. And yeah, I probably shouldn't shout out your mandate, Luke. So let's go ahead and you can do that. And you can tell us how many holdings you usually have and what you usually target because I'm sure you can do that better than me.
Yeah, all good. Thanks for having me back, guys. Really enjoyed the last time, and we left it in a good place. We said we'd get a bit deeper into the fund and stocks and all that good stuff. Yeah, no, look, so the fund itself been running for about 3 years now. We run relatively concentrated, usually between sort of 15 to 20 stocks, but always, the higher conviction weightings, let's say sort of top five would usually make up 40 to 50% of the portfolio any one time. Then you got a bit of a tail of smaller ones, obviously. And yeah, focus purely on Australia, small caps. Well, I mean, the smaller the better, as long as I like the business and the prospects and the outlook. Not tied to any sort of market size or liquidity like
Yep.
some other funds are, given their size. We are a nice small fund and sort of use that to the advantage. But yeah, no, super stoked to be back and jump into some more tangible. I think last time we were a bit more concept based. How we think about small caps and culture and management teams, and I
Yep.
think this time digging into some actual examples could be super interesting.
Yeah, completely agree. I'm not not sure the American listener is going to be too brushed off on the ASX small cap sector, but they'll get a bit of an education into it today. So yeah, I'll probably start off. Jay, do you have any questions first? Sorry, before
Well, what's
because I feel like
AXS?
uh,
ASX.
the Australian Securities Exchange. Do you,
So like the Wall Street of, or the stock market rather of Australia
yeah, it's
for our
yeah, it's like the
American guest.
MYSE, or I would compare it to that, but a lot smaller.
No, go ahead.
Sorry.
Alec, no, Alec, if
Oh,
you're going to
okay.
ask a question. Yeah, yeah. There's a
Oh
little
yeah,
lag.
all
Sorry.
good. Yeah, um, so we've just in Australia, we've just had AGM season. So the full year reports have come out a few months ago now, and now we're getting our first kind of updates after AGM season. Just just like asking Luke and wondering, what have you like been up to recently? Has anything kind of piqued your interest across the AGM season? I know with Merriweather, you sit there and you obviously look at companies before you buy them, you obviously track them over a long kind of term period. You've heard of them, you're still reading financial reports, but has anything piqued your interest in the last kind of period around AGM season?
Yeah, no, it's a good question. I always really enjoy AGM season, and I find it's very different to reporting season where Of course, at the AGM, the companies will go back and talk about the prior financial year's results. But because they've already done that, most of the conversation is more about the business itself. And it often, it gives you, as an investor, it gives you access to people that you wouldn't normally have the easiest access to. Because, of course, at an AGM, every director's required to be there. So normally you can sort of organise a call with a chairman or a CEO, but the chance to speak to other directors, I think, is always interesting. And usually at most AGMs, companies will have sort of the second level of executive staff there as well. You might be able to speak to a operating officer or CFO, things like that. But the other reason I find it interesting is, as I said before, the financials, of course, are discussed, but in Australia anyway. It's an interesting time of the year where most companies have been through their first quarter of the fiscal year, and they sort of have a pretty good idea of where the business is going. So it's the AGM where most businesses will usually give a trading update and potentially outlook or commentary on how the business is tracking. So I always look forward to it. I think you are correct that from an ongoing research point of view, it's rarely anything new or exciting in an AGM, but I think I always get good value out of AGMs, and in particular going to AGMs physically, and meeting people where, again, everyone has to be there in the room. It's the requirement under the ASX regulations. So it's one of the few chances you get to actually meet people and shake hands, introduce yourself, and sort of get that feedback hands on. So specifically, what did I see out of this AGM season? Nothing too crazy. I think across my portfolio, across the broader, again, focus on small caps, but you always keep half an eye across the broader market. I think it still remains cautious optimism for most businesses. I think, Jay, you're probably a little bit apart from the Aussie economy, but I think from where we sit, the US economy is doing quite well. On most metrics. In Australia, we're in a pretty tricky predicament. Our Reserve Bank has yet to cut interest rates from the peak, whereas most countries have. We've still got pretty sticky inflation, and so I think a lot of companies are sort of looking ahead and thinking, well, is there potentially pain there in the future, but not quite showing up yet. So it's a weird time, I must admit. I think that's you speak to these companies and things are going okay, but they're always sort of all looking ahead, going, but we're not quite sure of what the future brings. So it makes it hard, I think, for investors and for management teams. But no, I thought that was the general vibe I got from most businesses this AGM season.
You never really know what's around the corner. Like we've seen the first bit of the book written for next year, but yeah, we haven't seen the whole thing yet. But just the American viewers wouldn't really understand about kind of the Australian economy. And I think also a point to touch on is the Australian housing market, probably compared to the US. I don't want to be a kind of macro type of guy, but with our house prices being very, very expensive, it obviously puts a lot of pressure on consumers because our rates haven't gone down yet, and everyone's paying more than what an American person would for a house. So obviously there's more debt on the average household balance sheet than there is in the US. So it does change the consumer environment a bit. So especially like how Luke's saying, if he plays in small caps, they're still cautious about the consumer. It's not all blue sky.
I think as well, again, US listeners probably don't realize, but the 30-year fixed rate mortgages, which are quite common in the US, we don't have anything like that in Australia. At most, you could fix an interest rate for sort of 3 years, maybe out to 5 at some institutions. So because most mortgages are variable rate and they will move with the underlying interest rate set by the Reserve Bank, having those rates still at peak levels where they've been the last couple of years, it should be hitting the consumer probably much harder than it is. And I think that goes to what Aleck's saying, and I sort of agree with it, is a lot of companies, I think, are looking at things saying, we should be seeing more pain, but we're not really. And I think everyone's sort of dancing a little bit close to the door. I mean, times are still good, but you look ahead and you can sort of, why aren't we seeing the pain we think we should? I think it's interesting. But I think, like we said last time, I don't do a great deal of direct. I don't have many direct consumer stocks in the portfolio. I don't have many retailers. Don't have sort of travel discretionary companies. That's it's not so much a discrete view that I have, but I always struggle with the cyclicality that comes with those businesses, and that's sort of tying into what you're saying there, Alex. Like they're doing okay now, but that cycle can turn and turn hard for them. So, but that was the general vibe I got through AGM season.
Yeah, really interesting stuff. We can go more
Does
stock
con
specific. So, oh,
Sorry, does Australia have a gig economy?
Yeah, we do. Probably not as large, just because our labour laws are a bit stronger. We've got quite high minimum wage in Australia, so it makes it hard for those sort of gig economies. But of course, you've got your Ubers and your freelance style businesses. But yeah, our labour laws are pretty tight, so it makes it hard to really compete. Um, so yeah, not I guess it wouldn't be as large as a lot of other countries.
uh, sorry, can I just add another
Yeah,
difference
yeah.
that's really really changes things? In the US, you guys pay state and federal tax. Well, Jay, you don't pay state tax because you live in Florida, from my understanding. Um, but yeah, in Australia, we only pay federal tax. So the corporate tax rate with revenue of $50 million is 25 cents in a dollar, and then it goes up to 30 cents in a dollar, and then there's no state tax. Um, and then land tax, if you own multiple properties, then land tax comes into the equation, but you don't pay land tax in your primary residence. So I know you guys in the US pay land tax in your primary residence. So I feel like you guys pay more tax than we do. So that's something that also kind of changes the equation where it's not really 100% fair of a comparison.
Wait, there's you're saying after 50 million in like income, it's 25 cents on the dollar?
No, so it's 25 cents in a dollar up to $50 million in revenue. And then above $50
Oh,
million
revenue.
in
Okay.
revenue, it's 30 cents. Yeah, hopefully I've nailed the exact threshold of it being $50 million. Luke, am I right there or am I slightly off?
Honestly, yeah, I'm not sure. There is a threshold, but I don't know the exact number. You're right. But it does go from 25 to 30. I can't remember exactly what the threshold is though.
Yeah, okay. Well,
I
we'll
should know
run with
because I
that at the
remember
moment and
I've had a
we might
couple. I've
get
had a couple
corrected
of my
later.
companies. Yeah.
Yeah, it's a thing we see in microcaps a bit. So
Um,
I'm sure Luke's had a few portfolio holdings and once revenue gets over $50 million, you get that kind of extra tax hit. And then obviously
Oh,
after that, it never changes again. But it can move kind of the net profit around a tiny bit, which is annoying. But it's a thing you know that's gonna you know it's gonna happen. So yeah,
I'd
it's
like
just
your
kind of
guys' feedback on this for a second. In America, just to go to America for a second versus Australia's dynamic, you mentioned the fixed rate doesn't go past a couple years in
yep,
Australia. In America, you have the 15, the 30s, and then there's
yep.
different products around like adjustables. But like the culture, people refinance if like a lot. Or that's like, when can I refinance? So people are changing their rate, like trying to get lower or
Yep.
so I'm curious if you have any thoughts on that. Like um, like there's a different culture, right? If no matter what, it's done for you, it sounds like in Australia. But in America, it might be fixed, but then people are changing it. And also moving. I don't know, do Australians move as often as Americans do? Americans
Uh,
move every I think it's like on average, every 7 years.
you move
I know.
Uh,
houses or you move?
yeah, like houses. So do
Yeah, okay.
Australians, I don't, this is very random, but how long the average Australian stays in their home? Is there a amount of years that you know?
I wouldn't know exactly, but I would say stamp duty is probably incentivization to stay in your home for longer. And yeah, we've touched on it. I've touched on it before with you, Jay, but we get kind of a tax incentive to stay in our home. So you pay capital gains tax on properties or shares, but for your primary residence, you don't pay capital gains tax if you're still like living in that house. So you can kind of take your equity across and buy a similar style house in a different location. But I think it depends on the person, Jay. You obviously have your people that move around a lot, and you have your people that don't move much. Have you ever moved places, Luke? Like, obviously, you've moved down to Melbourne and come back up to Newcastle. But besides Newcastle, have you ever moved like in the last few years?
No, and we didn't own property when, back when I made that move. I don't know the exact numbers, Jay, but I'm fairly certain, Americans are one of the most mobile people in the world. I've
Interesting.
read stuff on that before. Yeah, no, it's interesting. Like, again, Australians, will refinance rates, but given they're very much tied to the variable, set by the Reserve Bank, there's not much. I mean, you might be trying to shift for a tenth of a basis point here or something like that. Whereas, in the US, given it's fixed, you can, obviously have big movements based on what's happening over the projections over a 15, 30-year time frame. So, but I think in Australia, the biggest impact, sort of to explain that process before, we have some insane amount of discretionary income on average going towards mortgage payments. I think it's something like 40-50% of income goes towards mortgage payments.
Really?
And of course, when that interest rate goes up the way it has over the last few years, it just means more money out of people's pockets. No one was. Oh, sorry, when I say no one, some people were locked into a fixed interest rate, but the majority of them have now rolled off, and so
Yeah.
everybody's at the mercy of higher interest rates now. And so that sort of goes back to what I said before. When you have such a high proportion of wages sort of sucked out of the system into mortgage repayments, we should be seeing more pain at retailers, at travel, at these
And you're
discretionary
not?
style businesses, but not really. I mean,
Not
most of them
really.
are still doing quite well, and like Australia is called a lucky country for a lot of reasons. We have a lot of natural resources in the ground. We have a lot of natural beauty, which attracts tourism. Um, and so, I think in a lot of ways, people have always been a bit surprised at how resilient the Australian economy's been. But this last sort of call it year or so with these higher interest rates, I think are really starting to perplex people now, particularly as retail sales in particular continue to be super strong.
How do you
People
see
are
that
sort of wondering where
affects
the money's
the
coming from.
well, actually,
I,
before I ask this, what is a micro cap or a small cap for people that are not familiar with the term, but they should know?
But there's no set definition for me. What I would call a micro cap would be circa sub 300 million market capitalization. I'd small cap, I would go up to sort of $1 billion in market cap. Mid cap would be 1 to 5, and then sort of large cap, anything above that. But of course, it's all relative, right? Like in Australia, to put some numbers to Alex's thing before, I only saw the other day. Australia is only 1.3% of the global stock market. The Australian index. We're a very, very small fish. The US is 64, I think it
yeah, I
was.
saw that.
Yeah, yeah.
Wow.
So
Wait, what?
yeah,
64%
so out,
versus
out, out
Of
of
one?
the
global
entire world stock markets.
the world stock markets, America's 64, 65%. Australia's only 1.2, 1.3. So our definition of a micro cap, is relative to the rest of the companies on our market, whereas, and they peak out at a few $100 billion for BHP as a miner, and Commonwealth banks, whereas obviously Apple, Nvidia, Microsoft, Facebook, several $1 trillion companies. Um, you've got a long, long tail of companies in the US. So the definition of microcap might vary a bit, but that's mine anyway. And I think it serves me well for when I'm scouring around the Aussie market.
Are they, is there fear around like volatility because of that uncertainty due to this financial market that you're talking about? Or how do I say this? Yeah. Is there a fear of volatility that you guys would have
Yeah,
as a
yep, yep, for
There's
consequence of
sure.
that uncertainty, as a consequence of um, the average Australian having that higher debt and the money, the cost of the home going up? That's what I was
Yeah,
trying to
maybe
ask.
maybe not like that sort of direct correlation between the two. Maybe not, but it all when you're talking about equity valuations and how things move around, it's a mosaic of all these different things which come into the valuation. But in general, I mean, when you talk about microcaps, the volatility does, scare a lot of people away. You can have a business that doubles or triples over the course of a couple of years, but that, for a microcap, that won't be a straight line. There'll be 20, 30% drawdowns in that time. And that's the volatility that puts a lot of people off, particularly obviously older people that are in a more wealth protection phase of their life. They don't want the volatility that comes with microcaps. But it's the volatility creates the opportunity for other investors who are willing to take on that volatility, stomach it, and take that long-term ride to the double or the triple, suffering those drawdowns as they come. So you can't have one without the other, basically. I mean, if you had a perfect world where stocks were always just perfectly priced and it was just a straight line up, that doesn't exist. It's the volatility that creates the opportunity for people.
Makes sense at university, but unfortunately, they're real businesses, and real businesses have bad quarters, bad halves. They have really good years and they have mediocre years, and it's your job as an investor to piece all that information together and then kind of make an intelligent decision around it. Like, I know SKS was a portfolio holding for Luke. It's a electrical company based out of Melbourne. And he bought that probably more than a year ago. And if you can expand a bit on it too, Luke. So obviously the share price just didn't go top, left, bottom, right. There was hiccups along the way for them. And then, yeah, they had some major contract wins, really boosted revenue. And then I think even a few months ago, you kind of just saw, I would say, a random bit of a sell down off good news. And yeah, the share price, there's always dislocations between the share price and the intrinsic value. For a lot of the time, I think it is fair, but if you look hard enough, you can definitely find dislocations. And I think when you have like a long-term kind of, I don't want to say a long-term compounder, but when you have a stock that's done quite well, I think the dislocations can be more common in those stocks, if that makes any sense, because the market's still trying to justify kind of the high valuation, which probably makes a lot of sense. But you still have the people kind of like your legacy holders, which are selling out. And yeah, I better let Luke talk because I was trying to ask him questions. But yeah, so if you just want to expand on SKS and kind of the journey on that over the last, I'd say 18 months from when you first bought it to today.
Sorry, I just dropped out.
You just dropped out. We're just talking. So I said, if you
SKS.
could expand on SKS and like the last 18 months from when you first bought it till today, like speak about like kind of the financials and how it's kind of.
I got everything except for the last little bit, I think.
Okay.
Yeah, no, look, so SKS Technologies and the ticker is also SKS, which makes it easier. As you said, it's an electrical contractor, and it's been obviously it's had a very strong run over the last 18, 24 months as a business. That's been reflected in the stock price. But I think it's also an interesting case study as a micro cap, which is, I'm sure that's why you've picked it as an example. So, it's an electrical contractor. They, they primarily the business was focused around sort of commercial fit outs of buildings, things like that. They were moving into the hybrid sort of audio visual IT market, which was a lot of customers when they were fitting out their offices. It wasn't just lights and electrical; it was also networking and computers. So they're doing a bit of that. And when I first invested in the business, that's basically what you were buying, and you're paying a fair price for that, circa 10-ish times earnings. And management had sort of said they were building up the capabilities to attack a couple of new segments, one of them being data centers. And, it's sort of how I like to think about microcap investing, which is if you can protect your downside with, a good solid core business and pay a reasonable price for that, and then you leave yourself the opportunity. Well, if you have some blue sky growth potential and a good management team that can attack and execute on that, then, that's sort of you let that work itself out over time as long as you're protecting your downside risk. And yeah, they just did a fantastic job. So data centers, as you know, I'm sure most people are aware, given the explosion in AI and the investment into AI, a lot of money going into data centers, and I think 60 to 70% of the cost of a data center is fitting it out electrically, with the
Wow.
electrical
Yep.
components and equipment. So they've won some very, very big contracts relative to the rest of the business. So circa, more than half of the business now or sorry, the pipeline of the business, I should say, is data centers. It's very much now overtaken what was the steady core business. And the outlook is only strong from that. So it's a super interesting example though, Alex, because as you said, you've seen the fundamental business do well. I mean, they'll essentially 10x their revenue from some 3 or so years ago.
Yeah.
Around 20 odd million to more than sort of 300 million this year. And so that's what
Well,
you've seen with the share price. The share price has sort of followed the fundamental business, where that multiple probably hasn't changed a great deal. You're probably still paying
Yeah.
around that sort of 10 times earnings. And so I think it's a super interesting example of, yeah, when you have these small businesses, you can get growth that just doesn't exist with large businesses. Just the law of large numbers. It's hard for a large business to 10x its revenue in just a handful of years, whereas these guys
Yeah.
can, because they're coming off that small base. So yeah, look, I can't look. I wish I could sit here and profess to say that when I first bought the business, I saw this pivot to data centers and huge contracts and 10x revenue. I didn't. Like,
No.
what I saw was a decent core business, well-run management team. And in a lot of ways, I know we had this conversation the first time we spoke, and I do encourage people to go back and listen to that. But that was one of the key things I really wanted to get through originally, was when you're investing, particularly in small business, so much of it is the management teams. They don't have those bureaucratic systems and processes that you have with large businesses, where the machine can run itself in a lot of ways. Like, for a small business, it's very much
Has to come back to the
the
founders,
people that
co-founders.
are running it. Yeah. So I knew they had sort of built these systems and processes in place to attack these new opportunities. I thought the downside was okay, and you were sort of backing some good people to go and execute. So no, it's done very well for us. I'm very happy with that. And as I've said to investors and others, it's a good example, I think, of the opportunities, particularly in that sort of micro small cap space, where, as I said, it's very hard to get that sort of growth from a large company.
Yeah, so Jay, we are a slight bit behind in Australia compared to the US. We have data centers, and we're usually slightly behind you guys with technology. So whatever you do, probably in a few years' time, it gets to Australia. So yeah, though kind of you guys are more developed around that. So we're kind of coming into the stage, as I said, that you guys were in a few years ago. So we're building out all these kind of more regional data centers now. And the ones in our cities have been built, and we're slowly expanding on that. But yeah, we're seeing regional ones pop up everywhere. And obviously, if we need more data centers, you're probably there's a lot of electrical work in the system that needs to be done. And obviously, SKS is definitely a beneficiary of
how
that.
much did the stock grow in the
Luke, do you
24
want to?
months? Like, what did it go
Yeah,
from?
about that 10x, so circa sort of 20 cents to $2, rough numbers.
So if I
But as
put
Alex
1
said,
million US, I could have made 9 million profit.
yeah.
Doesn't matter.
I'm moving to Australia.
When Jay, sit down, mate.
Dude,
We're yeah,
this is crazy.
we
Like,
no, we were just
because
using that
the
as
listeners are going to care about this type of thing. So you could make
oh
Yeah,
money doing this.
of course, but the thing with microcap investing, look, it's not quite venture
Maybe I
capital
should say we're
investing.
not giving financial advice or
No
something.
financial advice, of
I'm
course,
trying
but
to make it like tangible for our listeners,
yeah,
right? Like,
yeah. No,
I
no,
want to get rich, right? Like, you ever see The Wolf of Wall Street?
no,
Bad
that's a
culture,
terrible. Can we
bad
stop?
culture.
Jay, no, we're not talking about this, mate. Let's just
um,
stick to
We've
Berkshire and like
digressed. Oh
long-term
no.
investing and thinking
But
about
like,
businesses.
20 cents to $2, if I don't know anything about this stuff, that doesn't sound like anything, right? Meaning, just take ourselves out of the frame. 20 cents, $2. I'm trying to think like how I talked to my mom about that. She's 84 years old. 20 cents, $2. That's cute, Jay. But if you put $1 million and it becomes $10 million,
Yeah.
that means you made $9 million on $1 million
Mm. Yeah,
in
of course.
24 months. That's possible.
It's possible. Yeah. And the thing with it though, and as I was going to say before, it's not venture capital investing, but I think there's
Yep.
elements to how venture capitalists invest because in micro and small caps you can get you know, these stocks that do exceptionally well and they can 5, 10x in short periods of time. But you for every one of them, you'll find 99 that go nowhere, perform poorly, whatever. So for us as investors, that's why I think a portfolio approach is super important.
Yep.
And for a lot of micro cap managers. Look, I know some who run very concentrated, and that's they've got comfort in their style. But as I said before, for me with Meriwether Capital, we run that sort of 15 to 20 names. So you sort of you got that broader portfolio. You got some that are higher weightings and higher conviction than others. Because you always they're different stages of their business development and things like that. But if we had held this podcast, you know 24 months ago, and you'd said to me, go through your I've got a crystal ball and I can tell you one of your stocks is going to 10x in the next
Yeah. Pick
two
the one.
years. Pick which one it is. I would not have picked SKS Technologies. It was the boring electrical contractor.
Yeah.
To me, it was a steady sort of business and you're going to get dividends and all that sort of stuff from it. So I think that's why it's important for people. I'm sympathetic to you, Jay, because I say the same. Like embrace the volatility, embrace the winners, because there'll be plenty of losers. So celebrate the ones that do
Yep.
well. You want to own them, you want to be there. But the reason why is because for every one of them, you're going to have some that trundle along, go nowhere, some that perform poorly. On average, though, obviously, what you're hoping to do is outperform and hopefully significantly outperform whatever sort of benchmark or hurdle rate you're setting for yourself.
Yeah.
Is
It's
that
it's not
part of the
often.
reason you're what measuring the amounts? So
Of course.
you're
Yep. And for me, it's interesting. Like portfolio construction and portfolio weighting, it probably doesn't get discussed enough by managers and even individual investors. Probably don't put too much thought into it. A lot of people, will usually start with um, some standard weight that they'll have for a new idea. So some people might say, look, for every time I buy a new stock, I buy 3% of my portfolio in that stock. And then as things move, weightings change and it goes up and it becomes more. And no one, not many people put a lot of thought into then, well, how do I construct the weighting of my portfolio? It's not something I do day to day, but it's an exercise I like to do, once a month, once every 2 months, which is just sort of like go and say, am I comfortable with where things sit? And you're weighing up two things. You're weighing up, you know, trying to forecast where you think this business and ultimately this stock price will be in, a reasonable period of time. I usually look at 1 to 2 years. And then the other part is, well, what's the risk associated with that? And even in micro caps, some businesses are actually quite steady. They're small businesses, but they're operationally quite stable and steady, and you can forecast them with a decent level of confidence. And then there's others which inherently are operationally quite volatile.
I want to make
They're,
sure I
they're in.
follow. If I have
Sorry.
20, I just want to make sure I'm following you as like the late, right? If I have 20 names, uh, uh, and I have $1 million to invest, and 40%, yeah, um, 40% of my portfolio, right, is going to be in 5 names. So then it's 80,000 in each. And then the remainder would be 40,000 of the other remaining 15
Mhm.
kind of thing. Is that kind of the
Yep.
basis of that? And then
Yeah,
the
yeah,
question
and
becomes,
I'm
what are the names and
yes,
what's the
exactly.
story?
Yeah, and it might
Just
not be 8, 8, 8, 8, and then
oh, but
say,
even that could
it,
be,
it could sort of bounce around, but on on roughly speaking, for me anyway, this is some people, everyone does it differently. There's no right or wrong answer, which is why it's an interesting conversation. But the comfort
yeah.
that I've got is those top five names are circa, let's call it 6 to 10% weightings. and then the rest are sort of around that sort of 2 to 5. And so within those bands, they fluctuate themselves on how the underlying stocks do. If they do well, obviously the weighting in the portfolio goes up. And then, it's me coming over the
Oh, it
top and
goes up
saying,
because the money grows.
of course, yeah, yeah. So if an individual position does well, it becomes a bigger weighting in your portfolio, or other ones can pull back. You can have the rest of the portfolio performing poorly and one stock sort of holding firm, and
But how do
and it
we know
naturally
if
becomes a
when
bigger
it's
weight.
time to buy more when it's going down and hold when it's going up?
Well, again, there's really no right or wrong answers to these questions.
Yeah.
There's a famous saying of don't water your weeds, water your flowers and pull your weeds, which means some people say add more to the stocks that are doing well, even though they're becoming a bigger weight.
If I watered my weeds, I would have stayed with my ex-girlfriend and not married the love of my life.
I knew
You
you
I
were
get
know
going
there.
I'm
there.
talking to you guys. This is fun. I want to
Yeah.
be a
Well,
contender someday. This is great.
water your
Yeah.
weeds means, you've got your portfolio, and 6 months in, you've got some stocks that have performed poorly, some that have performed well. And water your weeds says, well, again, if nothing's changed fundamentally for how you view these businesses, then the academics would say, well, take some off the stocks that have performed well because they're now overvalued, and add that to the stocks that have performed poorly because they're now undervalued. But I think what Alec was saying before, and I completely agree, is that like that's the textbook, that's the academia of it, and that sort of market doesn't exist. And so stocks that are performing
Interesting.
well are usually because the business is performing well. And if the business is performing well, then it probably does deserve to become a higher weighting, to have more of your capital applied to it. And the ones that are performing poorly, again, it's the opposite. It's usually the business, something's gone wrong, and you know, and so some people then sort of invert that academia on its head and say, well, pull your weeds out, sell your losers, or trim your losers, and add to the ones that are doing well, and give more love to the stocks that are performing well. But as I said, there's no right or wrong answer, because, like Alex said, stock prices can move separate to businesses. So there's plenty of examples where a stock price is moving, but the underlying business isn't changing. So of course that's the example. You should be buying more. If you liked it at a higher price and nothing's changed, then you should love it at a lower price. But psychologically, it's sometimes hard to do that. So it's why we love this game. There's no right or wrong answers, and I think I say this quite a lot. I think it's important for people to find what works for them. Um, obviously, read about successful investors. You quoted Seth Klarman at the start. Investors like Seth and Peter Lynch, and obviously Warren Buffett. There's so many books and stuff written by these great investors who tell you how they think about it and how they do it. Like, absorb all that. Listen to people like me if you think I add value. But the most important thing, obviously, is when you're doing this for yourself, you've got to find out what works for you. What's
Yeah.
your risk tolerance level? Like, how many positions are you comfortable holding? Some people find they can. Peter Lynch famously held hundreds of stocks at one time, and then others hold five. Super concentrated. And
Mm.
there's just no right or wrong to it. It's about what works for you, what works for your emotional side of investing.
I've,
So you go back to that Klarman quote, what keeps you steady while everyone else is panicking. And you've got to find that for yourself, and really leverage into that.
I was just about to touch on weight because you said that you told 4 or 5 holdings to be 5%, and I was thinking, as the novice kind of listeners listening to this, like 5%, I would say quite high. So like that's not going to work for everyone. You have to try to work out what's right for you, and you also have to judge the opportunity set that's in front of you. So
Mm.
that's another thing with investing. If you think you've got a really good opportunity set, you're probably going to want to put the stocks at a higher weight. There's no way of exactly knowing, and then you obviously have to manage your own personal risk with your own personal financial circumstances. And then, yeah, you might have, yeah, it's really hard because it's all about your opportunity set too. So if you have 30 or 40 great ideas, then putting in 2% or 1% positions makes a lot of sense. But in reality, you're probably not going to have 30 or 40 great ideas. Like Buffett does speak about having the punch card of after you finish college or university, if you come across 7 or 8 great ideas, that's enough to make you a lot of
Why
money.
do people say that you can't beat the market but Buffett has.
Because
Um,
beating the market statistically is a very hard thing to do. Sorry, Luke, go ahead.
mm,
But
well,
absolutes, right? Only a Sith speaks in absolutes. But then that's an absolute too. So my head hurts.
going around circles.
Star Wars
Um,
references, yeah.
So a few parts to that question. One is when most people talk about that, they're usually talking about professional fund managers, and the key reason for it is basically fees. If you have a look at the big broad data set and averages, the market does circa 8 to 10% a year, and most fund managers are 1 to 2% below that, and it's basically the fees they charge. They do sort of meet match the index, but underperform because of fees. Um, but as you said, like that's the average. You're always going to have to get to that average. You're always going to have people on both sides. You can always
So
find
do you
fund
think that
managers who.
adage confuses or doesn't take into account value investing as an ethic?
No, it does. Just as value investing is very hard to do, in my opinion. Sorry, Luke, go ahead.
No, you're
Okay.
right, mate. You keep going.
Yeah, I was like, obviously you have your people that beat the market, but on a whole, it's pretty hard to do. And I also a reason for that. A lot of fund managers kind of mark their they mark a benchmark and they obviously try to outperform the benchmark. But when they benchmark against something, sometimes mimic what is in the actual benchmark. So they mimic the index they're trying to beat, and then they'll underweight stock specific or overweight stock specific if they think the stock's gonna perform well. So if you're doing the ASX 200, they would, or like if you're doing the S&P 500, they might have less weight in Apple and more weight in Nvidia, and they think that's going to help them. But it would only be slight variances and slight changes, and they would still probably want to own every stock in the index. Where if you're truly trying to outperform, you're not going to want to own every stock in the index, then take a fee. It's not You're not going to get much underperformance or outperformance. But I suppose if you don't get much underperformance, people aren't going to be too upset. Um, but if you, yeah, they're mainly just trying to build a business and retain a business around it, not outperform the market. I think that's what brings a lot of professional money managers unstuck. I think that's an
I,
angle.
I think as well. Go back to something I said before about small micro cap investing and sort of use that venture capital example to say, you spread yourself across a portfolio and you're hoping to catch the stocks that do well. That's what the index does. The index, it holds every stock. It's always going to hold the winners. And over history, particularly over long terms, the data shows that the vast majority of share market um, you know, you have your Nvidias, your Microsofts, your Googles, your Facebooks right now. They are driving the index. And if you go back through history, it can be oil, it can be, consumer stocks, media. There's been different sort of it comes and goes, but the index is always guaranteed to capture, the Nvidia that does super well. Whereas
Yep.
active managers, obviously that's not
Sometimes can be
guaranteed.
completely
You
missed.
can miss them out. So I think that's why for a lot of people, the idea of just index investing to me makes a lot of sense. If you don't have the time, the effort, or willing to sort of build up the knowledge base to invest actively, you're guaranteed to always get the winners of tomorrow and the market. There's a reason why the market generally goes up because we're continually innovating and these new businesses are emerging. But and I wouldn't be here today if I didn't believe it. I think there is the ability for active managers to outperform an index through active stock picking and looking to, you know, as Alex said, overweight, underweight, ignore certain sectors and
But
whatnot.
is it akin then to the fact, okay, is a good analogy then, 80% of businesses fail in the first 5 years, 80% of those businesses fail in the following 5 years. That leaves us with 4% in the first 10.
Mhm.
if we take that same thesis and add it to value investing, failing would be not beating the market because I'm in the business of
Basically.
capital growth. So
Yep.
like so there was this course I was taking the other day and they talked about Price's law, which is if the square root of any group of people, it does half of the performance. So if you have 100 people, 10 of them will do 50% of the, let's say, sales. So there's always going to be some type of like breakdown or
Yeah, power law.
hierarchy, like okay, power law. So
Yeah,
is
yeah.
that what like I don't know, I'm just trying to like
Yeah, no, very
conceptualize it.
much. That's so you know you can so when most people say the index, they're talking about the market cap weighted index, S&P 500, ASX 200, whatever index you pick. You can buy products like ETF products that are equal weighted. So let's say you take the S&P 500, it would own 0.2% of every stock in that index and just equally own them all. But most of them, when you put $1 into an ETF, the S&P 500, I don't know the exact numbers, maybe Aleck does, but you'll end up with 4% Apple, 5% Nvidia, whatever their weightings are within the index. So that's that power law in effect, where those
Mm.
businesses have been that top 1-2% of US companies, especially over a long period of time for most of those now. They get to the point where they now dominate the index, dominate the weighting. So when they perform well, it has an outsized impact on the index itself because they are a larger weighting than if stock 500 was to be, cut in half tomorrow and lose 50% of its market value. The index, it would be a tickle to the index. It wouldn't even notice. If Nvidia went down half a
Mm.
percent, it's a bigger impact than if stock 500 goes down 50. So that's where the power law comes in, and it applies to the 80-20 rule, Pareto's principle, I think it's called as well. It applies to so many different things. You see it everywhere once you start to look for it. But it's the idea of yes, that small selection of a group generally produces most of the output, and so as active stock pickers, and this is what Aleck and I do every day. You're looking to find that 20, that produces the 80, and you know, for Meriwether Capital, we've been pretty
Can't
fortunate.
be
Like
the
if,
20 or the 4
yeah, that's right. Yeah, that's what you're looking
to
to
be the
own, and
4.
you don't want to own the rest. Um,
No,
and
I
so
meant
that,
you want to also be, I think, right? You want to be that 4% that there's a connection. Not
yeah,
just
yeah,
look
yeah,
for the 20, or I guess, is it
Yeah.
your capacity to look and find the top, that 20%
yeah, yeah.
reflectory of if the money manager is in that very small minority of those that beat the market? Because
Well, I think that
it's
I think what's
possible.
hard is as you see with every piece of financial media, and you'll see that tagline saying that past performance is not an indicator of future returns.
Yep.
And so what makes it so hard for people is you can have these managers who have, they've been that top four, they've in the
Uh-huh.
past, they've executed, but markets change and market dynamics change. And,
Yep.
people who were classic value style investors have found themselves left behind because the
It's
market
funny.
has pivoted to growth.
My wife told me that, and so I started date night. I'm kidding, but I think it's an important metaphor. It's like
Yeah, yeah.
we have to water when you meet Jenna, you'll understand. It's a wonderful dynamic. But like
but
past doesn't predict future. We have to work. We have to build this. Or
yeah,
sorry,
yeah.
like
And
Churchill
so
said, don't interrupt me while I'm interrupting.
no, if
I'm
you
getting
go
excited.
through, again, the data shows if you go through any longer period of time, let's say 10 years, almost always you'll see a changeover of the guard at the top of a market, particularly the US. You had sort of oil and energy stocks through the 70s. And then I think the 80s was sort of media and industrials conglomerates where there was a lot of, sort
Yep.
of big businesses being formed. 90s was the tech bubble. The 2010s was the rise of the financials before the GFC killed all them. And then the 2015s and to now has sort of been the rise of, tech again, I suppose. And so, you see these changing of the guards where if you were on the winners of the last decade, you weren't going to they're gonna fall away, and that's markets. That's how society works, and it makes a lot of sense that that's what happens. And so as investors, like I'll bring it back to myself. Like, yes, I've owned SKS, and I still think SKS is a good opportunity. Can it 10x from here in 18 months? I'd be very, very surprised now. That would be, almost impossible. So where's the next one? And we're not. I know Alec would agree. We're not necessarily looking for 10x's, but
We're not, yeah.
the potential for them is out there. So,
Mm.
where could the next one be? So as an investor, you've all the eye to the past. It helps shape things, but you've got to have some sense of looking forward and saying, well, what's going to be at a portfolio level, at an index level, at an individual business, what's going to be that next driver for me? So
Well,
Luke's,
it's
how
tough.
much do you take into account innovation?
Oh, it's everything. If you're not innovating, then you're slowly going to be competed away. Especially where we are in small micro caps. You're not going to find monopolies. You're not going to find these businesses that just exist and can run themselves and spit out cash. You might see that up at the larger end with toll roads and other things like that. Um, so small businesses, a lot of times they're running to stand still with innovation. You're always got
Mhm.
competition coming and eating at you. But it's super hard because as investors in particular, on the outside looking in, it can be hard to sort of make a concrete sort of view that a company is innovating
yeah.
and maybe even innovating in the right place. I mean, you can sometimes have R&D money get wasted if it's not in the right area. The market can move and businesses can often be left behind. So it's super important, but again, I know we spoke about it last time, this idea of qualitative versus quantitative. It's easy. The numbers are easy. The numbers are the numbers, but it's those qualitative things. It's, are you innovating? Where are you innovating? Who is in the R&D team? Who are the engineers driving it? What's their experience? What's their view? Um, that's, but again, it's why we enjoy doing this and trying to find all these things and make these views.
I was just about to say unfortunately, you can't model out innovation. You can't put a new spreadsheet and go, I think this company
Exactly
is going to
right.
innovate at a certain percent a year. Yeah, so it's definitely very hard to do. And like Luke's not trying to find the next 10 bagger, like he's not trying to find the next SKS, but he is trying to find actively right now the next stock that's going to outperform. So yeah, that's kind of a better way of trying to explain that. But
That's right.
obviously, that's your job as a That's your job as a manager. You're trying to work out and invest in companies where you think the risk is not as much as the reward, and you think you're going to be adequately compensated, which he touched on earlier. So yeah, I just want to make it clear that Luke's not kind of gallivanting around trying to find the next 10, 20 bagger, and they're just so easy to come across because
Mm.
unfortunately they're very hard to find. And yeah,
Well, I'll put it this way: like, if you said to me today, I couldn't tell you the exact stock, but if you said, where do you think the next 10x stock will come from on the Australian market? I guarantee it would be some mining like that in the middle of nowhere in the
You
mining
cut out
explorer.
Luke, but I laughed at what you said because yeah, I heard you started with mining. So yeah, but that's
Yeah,
something
yeah,
that it's so hard for the layperson to um, understand because obviously most lay people aren't geologists and they don't have a good idea about an ore body or
Well, it's
a
just the
company
name.
like
So
that.
basically, what I said before I cut out was, if you said to me, "Where's the next 10x stock on the ASX going to come from?" It would almost certainly be a mining explorer. Just the nature of those businesses, they're lottery tickets. People there's a residual value to the business, but basically, it's a gamble on the drill results. Will they strike gold? Sometimes literally, and then the stock will shoot up. And that's, to me, it's gambling. That's how I've always viewed that style of investing. So I think you framed it very well, mate, which is, you're putting that risk reward, you're putting everything together to come down to basically a risk reward. And then it's, do I think from where this business and this stock sits today, can it outperform? Again, whatever you set for yourself, whether it's a broader index, an internal sort of, some people say, I want a 10% return, 15, 20, whatever your number may be. Does this get me to above the return that I want? You're looking to put together a portfolio of businesses like that. And then what makes it hard is like, you know, we can have a lot of conviction and confidence in these businesses and stocks, but you're always going to have some that just don't work. Whether your analysis was wrong, whether something changed within the business that you didn't quite see happening, and so it's sort of having the humbleness to be able to acknowledge that you will get some wrong, and being able to adapt as that happens, which comes back to that watering the weeds versus
Yeah.
picking them out sort of analogy before.
Also, when a manager underperforms, it's not always a bad thing. Obviously, if you're underperforming over the long term, it's obviously not great because you have investors in your fund and you're charging them. But like an example in obviously Luke's portfolio recently, like Visan has been delayed, I would say, with the asset management business. And like obviously the performance hasn't been great over the short term, but over the longer term, let's say the asset management business does start, you would assume it would add to a valuation, and yeah, then there would probably be a period of outperformance. So there can be like, I sound like a actual ASX management team here, but there can be a transformational period where the company is building to its next leg of growth up. I feel like you saw that with SKS probably 18, 24 months ago, where they really stripped back and kind of went again. That's a very simple way to put what happened at SKS. But yeah, if you just want to expand on that, Luke, and any thoughts, obviously, on how a transformational period in a company can be good, and obviously stock price can't always run, unfortunately.
Mm. No, it's a good one. So yeah, so Visan was the company you talk about there. It's ASX ticker is VYS. Um, so these guys, to your point before, they're trying to embark on they've got a core business in the water services space, primarily for mining companies, removing water from underground mine sites, and then a few other things. I won't go too in depth here today.
Yep.
But in essential, what they're trying to do, which would be a big transformational change for the business, is to get into water rights management. So again, for the US listeners out there, when you picture Australia, if you sort of cut Australia in half, and you've got Western Australia where Aleck is
Those
located,
weird people.
the weird people over west, yeah, that's where all the iron ore is, and it basically funds our country, digging up iron ore out of the ground and shipping it off to China.
Jay,
Um,
we're the rich ones. We don't get our fair share of the cake though. We do all the work, and
I thought the
the people
largest
from New South
export,
Wales just take all of our money and build some more buildings, mate. It's very sad.
I thought the largest export in Australia was kangaroo milk.
we keep all that for ourselves. That's the good
I've been
stuff.
saving that joke since episode one.
Someone's gonna listen to this from Australia and just start like, oh geez, they're just gonna start cracking
Uh,
up on that one, mate. No, no.
so
Unfortunately, it's iron ore, Jay. But getting
iron
back to
ore
the
and coal.
topic.
But so what Visan's trying to do is basically over in the Pilbara, where a lot of the iron ore is based. There's a big lack of supply of water. There's underground aquifers, and getting that out of the ground, and they're working with native title Aboriginal land corps to sort of 50-50 joint venture, come up with commercial agreements, get water out of the ground, pipeline it to where it needs to go. It's a big task, water rights management for big portions of the country, and so as Aleck correctly points out, if Visan can juggle the regulatory issues, the permits, working with their joint venture partners, working with their commercial partners. There is competition from desalination as well. So, all these sorts of things. But if they can sort of execute on the plan, it's a substantially bigger business in a few years' time, and much more profitable as well. So the market, to go back to your question, mate. So how does the market view this, and what opportunities does it create for investors? Well, you know, the market is not efficient in any way, but the market does value certainty. So for businesses where you can look at the business today and look out sort of 2-3 years in the future and have a pretty good idea of, what's revenue going to look like, what's profit going to look like, the market will always put a premium on
Yep.
those sorts of stocks because it values the certainty of those cash flows that will come back. So Visan, as we sit here today, it gives you some certainty with the core business that does exist. It will have its revenues and its profits, but
Right, it's
there
cash flow.
is uncertainty over, well, what might become of this opportunity. And so, how that gets valued, I think creates really good opportunities for investors who put in some work, understand the potential, understand that the timelines, as Alex said, when could this sort of come online and start contributing. And, you know, it's one of those things where, again, you get rewarded for the uncertainty and the volatility. Like I said before, as investors, if you're willing to embrace that and say, look, this is uncertain. I don't know what Visan's water asset management arm turns into, but I will embrace the uncertainty today for potentially a much larger payout in the future. And some people don't want that uncertainty. They would rather stick with bigger, stable. There's a lot of businesses on the ASX and around the world where they'll grow at GDP. They'll grow at 2 to 3% a year, and basically that will be the business you'll get over time. Whereas
Yeah.
Visan, of course, small business looking to do some really, really interesting things. And I think, again, go back to my conversation on SKS, and I think people who have listened to the first conversation and picking up this one, you'll see the common theme of I really like Visan's management team, and it's that very similar thesis of, I think, the core business underpins where we are today. And I think you're backing a very good management team to embark on some blue sky opportunity and execute. And that's the sort of investment setup I really like. It resonates with me. And when they work, you get your SKSs where they can really work. And of course, some don't. Business is hard. There'll be plenty that I own and plenty of others where they could be in a similar situation, but of course it just doesn't work out for them. Wrong time, right place, or right time, wrong place. Who knows? And things just don't quite work, and it just doesn't quite hit. And that could be Visan. I'm confident things are tracking well, but there's no guarantee that it works. So it's another. I think you picked another good example there of sort of what I look for and why.
Yeah, so that's kind of where the dislocation in price could be if that asset management division does start. It's not like the market will slowly front run it till it starts. Right now, I would say it's not in the price at all. So, yeah, sometimes the market doesn't price it in, obviously, until it starts producing cash, which is very fair. And that's where you have your kind of valuation dislocation, where if you're in a stock 6 months before that happens, you have to wait for it, but then you'll get your period of outperformance. Maybe I'm not saying it's guaranteed at all, but it's something that it just goes to show that markets aren't fully efficient. That would be my best way of trying to explain kind of a different angle to what Luke was trying to say.
There's the old it's the old Ben Graham quote. So it's been around for like a century or 90 years or something like that. But it's the voting machine versus the weighing machine, right? So it's this idea of the market in the short term. It's a voting machine. It's people's emotions and all that sort of stuff is what's driving a short term stock price. And then the weighing machine over the long term is basically the long term stock price will be the performance of the business. You'll get these fluctuations over time.
Yeah.
Does. So I'm a firm believer in that. And to me, that underpins my investment philosophy, which is I'm willing to fully embrace the short-term voting machine, knowing that can mean underperformance. But I'm a firm believer that over the long term, the weighing machine, and if the businesses do what I think they will, then the stock price will follow. So yeah, to your point, the market, I think, over the short term is, I 100% agree with everything you just said. Over the short term, you get these dislocations in price and what the business is worth, particularly with its future potential. But the idea is over the long term, that sort of that value will be realized over time. And it usually happens, like to your point, it doesn't happen in that straight line. I know we said that before. Like you don't just get this steady straight line where it's okay, Visan's here, and then in 3 years, Visan's the bigger business, and you just get a steady.
It's not like the market steadily front runs the move of the asset management
not
division
at
if
all.
it ever comes around.
It's the stock goes nowhere, and then usually there's just a catalyst, be it a financial report, customer wins, something that sort of catches the market's attention to say, okay, the business is performing better than what people expect. And then usually you see this like strong catalyst catch up recovery to roughly where the value is. And, that's sort of particularly, again, for micro caps we're talking about here, where you often have less eyeballs, less liquidity. And so those catalysts to value, sorry, when I say catalysts to catching up to the underlying value of the business.
To what degree could these to what degree could these technologies and cultural shifts towards self-directing passive capital flows misprice the market?
I think in Australia, I think our system's obviously different to yours too. So we force everyone to put 12% of their wages into their 401k at every paycheck. Then that gets paid into a superannuation to like a 401k fund at the end of every quarter. So you have a lot of passive money flowing into the indexes. So I think for our bigger index, like the ASX 200, I think the companies in there usually kind of get a valuation premium on a whole compared to the companies outside of the ASX 200. Luke might want to go against what I'm saying there, and I'm not correct on every company in the ASX 200. I certainly know that.
It's
but yeah, as a whole.
Yeah, no, look, it's a super interesting question. A lot of people have been asking that question and thinking through the ramifications of it, the mechanisms of it. So Australia, it's interesting you have us on to ask that question, because Australia is probably one of the leading countries in the world, maybe someone like a Norway as well, because I know they've got a large sovereign wealth fund, but we've got this pool of, we call it superannuation, but retirement assets. It's $3-something trillion. It's a huge pool of money, and most of it is in, as you said, Jay, passive style investments. Some people have what we call self-managed super, where they actively manage their own superannuation, but 90-something% of people, it's just a passive, and well, it's up to 12% of our income goes towards super every week, something like that.
Yeah.
12, yeah. But the value of the ASX, so as I said before, try and square these two numbers. So you got a superannuation pool, it's 3-point-something trillion. I think the value of the ASX itself is only 2-point-something. So our superannuation, if the government one day said all superannuation assets in Australia needs to be invested in the ASX, you would have this flood of passive money that has to drive up the value of the ASX, because it's worth more than the ASX today. Now, that's not currently how it's set up. Most passive funds are generally sort of 30 to 40% Australian listed assets, and then international listed, private equity. They sort of diversify across things. But a lot of people, particularly in Australia, because of the way our market's set up and because of our super system, sort of have this view of, well, if 12% of every Australian salary is going into superannuation every year, and a big portion of that savings is going into the Aussie stock market, I mean, does the stock market just go up 12% every year? Because the sheer value of the passive money, does it overwhelm everyone else? Now, I'm still a believer that, look, I think there's times where I think I see just that steady drift of passive money come into the market, but I still think you see, particularly at an individual stock level, I'm sure I said this the first time we spoke, but it's the incremental buyer and seller that drives the stock price. And in most cases, that's still, someone making an active decision. I don't think we're anywhere close to passive money completely dominating the index. You still see stocks, will shoot up on good news, get sold off on bad news. There's still the rational, active response to the fundamental changes in business. So that gives me heart that, despite Australia being much further down that path of passive investing compared to some other countries, we still have enough of that sort of active investment to see the actual proper fundamental changes that you should see.
I do.
What about? Oh, go ahead.
Yeah, I was gonna say I do think it is a bit distorted. Like we do have, if you go for a bit stock specific, we've got like, so our biggest bank, I would have to be, it's Commonwealth Bank, and it would have to be one of the most expensive banks in the world on a valuation point of view. And then like if you're paying for growth in the ASX 200, like I haven't checked CSL's valuation for a while, but it's usually around 30 to 40 times earnings. So I think if you're in the US, you're buying stuff from I would say 15 to 20 times earnings, and most people in the US are complaining if a stock's kind of if one of their bigger stocks is on about 20 times earnings. So we've got a bunch of companies like if you're paying for growth, you can be paying like 100 or 200 times earnings, which kind of makes the .com bubble look like it's nothing at all. Not to be, I sound like a very bearish kind of person there, but there's a few stocks in the ASX which are vastly too expensive and don't make much sense on a valuation basis. But yeah, it's obviously our job as active managers to look through that and try to find the stocks that we think are going to outperform.
Uh, for those that are listening that are pursuing that are interested pursuing to interview qualify the likes of your kind to partner with to grow their capital, right? The value investors. Uh, like, what advice do you have on them of what percentage ranges of their net worth to put into this, um, you know, tranche of their wealth creation? And I say tranche because if I understand correctly, this is a different approach, and you're arguing a quite capable and very valuable approach, pun unintended, as there, in comparison to other ways for people to invest, like private equity or with a money, what do you call it, like a personal a financial
Mm.
advisor,
Yep.
like, or even if you don't give obviously specifics, but like in your experience, the breadth of your experience being around people that are the limited, that are the investors. What would you call it? The investors, those,
Yeah, the fund managers.
uh, well, like the people that invest in with the fund managers.
Oh yeah, yeah, yep. Sorry, the
Yeah.
investors. Yep.
Yeah, yeah. Like what, if you can talk to them, how to think about it, what to look for. Um, and then I have another question, if you can elucidate on like the difference between, getting 10% or 12% versus 11%. Because even something that it could be such a different candlestick.
Hmm.
Yeah, I
Yeah, well, I
don't.
mean, to take your second one first, I mean, yeah, 1% doesn't sound like much until that's stretched out over a long-term period. And then, if you stretch that out to 15, 20 years, an extra 1% makes all the difference. That goes back to that conversation before about fund managers and their fees. 1 to 2% doesn't sound like much until it's over a long period of time. To go back to your first question, I think we spoke about this last time as well, and I said something along the lines of, um, again, there's no right or wrong answer, and it comes down to the individual risk tolerance. So I'll speak for myself, and we're in micro caps, small caps, and it's inherently going to be a more volatile area of the market. The first year of the fund, the fund was down, about 33%. Roughly a third of the fund's value was come off in its first year. The second year was up 10%, something like that, and then this year we've done 42. They're numbers, and so if you take those percentages, we're about square over a 3-year period. But it's been a very volatile ride, for investors who took a third loss and then 40% this year. So there's some investors who, quite rightly for their risk tolerance and maybe where they are in their capital base, if they're trying to preserve that capital base versus grow it, will just say, look, I, appreciate what you're doing, and obviously the potential for big returns is there. You can see that when you do a 40% year, but the fact that your strategy can do a negative 30%, it's just not something they're comfortable with. So,
Uh,
I
Sorry, I was just laughing because that to me that's like leaving the spouse because the 3-year-old can't drive a car.
Well, it's another one of your classic analogies, but I like it.
I'm upset about for that.
But it
That
comes,
upsets me.
Yeah,
It seems like, why'd you get
well, that's
started?
that's a good thing, but and because to me, what that tells me is that you've got the emotional aptitude for investing. Because I find that people who can stomach losses, you know, they've got the right emotional base to be able to invest for the long term. A lot of people
yep,
don't have it though, and that's why,
yep,
and I've seen it on both sides. As you know, I'm a fund manager now, managing money for people. I've worked for a financial planner where they were providing advice to people on how they should invest. And a lot of people think that they can, invest and they have a long-term focus and this is what we'll do. And then at the first sign of volatility or weakness, they're out the door. And of course, whether it be COVID, where you saw that really sharp decline on global markets and then really, really quick bounce back. GFC, if you go back 15 years ago, where that was more drawn out, but a lot of people capitulated on that 18-month stretch from 07, 08. And then you miss out on obviously the incredible gains since then. So I think again, and I've said this a few times, but understanding yourself, it's so important in investing. Understanding, do I have the risk tolerance? Really have the risk tolerance for the sort of micro cap strategy that I run. And I'm, if the answer is no, fantastic. Like I think I said this last time. I don't think what I do suits absolutely every investor. There's some investors out there who they don't need the exposure to micro caps because they're maybe comfortable with their current wealth and capital base, and they're just drawing that down in retirement. Fantastic. Like there's no need to take on the added risk of micro caps. But for me, Alec, we're both younger. And for a lot of investors, if you're in your sort of 40s and 50s and you've got 15, 20 years before retirement, then having some part of your capital base, again, whether it's micro caps, venture capital, an asset class that gives you that little bit of potential, I should say. There's no guarantees, but potentially gives you that little bit of extra, gains on top. And then how you balance that within a broader, I've got some private equity, I've got some large listeds, I've got some, private business, property, however you balance it all together. I think that's the key conversation to have, Jay, is where does it fit within an overall strategy?
So it seems like
Um,
it's a wealth mindset matters or a wealth philosophy because no wonder the wealthy get wealthier if they have the resources to and the foresight.
mm,
Like, right, because I would think someone less wealthy, less resources, that's going to impact emotions, risk, right? Risk.
yep,
for
The
sure. And
well,
and just
like
time as
this is
well,
no
time and
wonder the world
experience.
works that way, right? The wealth gave
Yeah.
wealthier people that are listening have to think in the wealthy way, I guess, in a sense, and
Yep. Yep. And just just the time and experience you get doing it, like, if you have some people, some listeners who are maybe starting out on the investing journey and they've, maybe not paid too much attention to it. The first time you go through that sort of market cycle where, you know, Jim Cramer on CNBC, would always do the market crash special at
no,
seven
I think it's
o'clock or
markets in turmoil. I like
markets
it's
in
yeah,
turmoil. That's right.
usually,
Yes.
and I'm pretty
The first
sure.
time you go through the cycle and you get the markets in turmoil and the headlines of the media.
mm,
It's not pleasant. And what you lack the perspective. So Alec and I, we laugh about this now because you lack the perspective of, you probably see that headline two or three times a year. The first time you see it, you think, and your mind goes back to the GFC and COVID and all these crashes and the 1929 Great Depression gets thrown around by some people, and then you quickly realize that the headlines in the Wall Street Journal or CNBC, wherever it may come from, markets in turmoil or X billion dollars wiped off S&P 500 today. It's time and experience shows you that you just sit these things and you sit down and let these things pass. But for newer investors, when you don't have that sort of viewpoint or that experience, it can be tough, and that's where a lot of people do panic and will often, in Australia anyway, will often sell equity, sell shares, and go back to property investing. Property investing is far more common in Australia than equity investing. And the main reason why for me, like people will say, oh, it's because, property goes up, whatever. The main reason why is because you don't get your property value, shown on
Shown
a
to you.
computer screen every day. Most people, it's as you said, Jay, if it's every 7 years, it's only every 7 years you really find out what your property's worth. So you don't get the volatility of all these daily news and headlines. Whereas with equities, it's so visible to us all.
Maybe this is just an open loop for next time. You can kind of coach me through this, guys. But I feel psychologically called to the idea of like uh paying down, and there's tax ramifications to this, but I'm taking personal testimony, like paying down the home mortgage, and lowering the interpersonal risk or the personal balance sheet risk, and being more aggressive in the equities market as opposed to being like, more aggressive in the bond or like the fixed instruments, and less aggressive as a younger person, less
Mhm.
aggressive in the equities. Like that's like that makes me feel like more psychologically. It is so much of what you said, right? What's right or what's wrong, and like how much of this is just how we feel. Like I wrote, and there's a question here. I'll shut up, but I wrote this down earlier. It was like, does math tell the truth or help us justify our truth of the truth? Like so much of this is the obviously the numbers don't lie, but liar figures lie and liars figure. Like so much of this is like how am I going to as an individual, as a business person, as somebody looking for the independence and wealth in 20 years, 30 years, how am I going to just take it as seriously as possible? Another thought I wrote down was like, we are rewarded for paying attention. This is a takeaway I have from your guys' master
Mm.
class today. We are from the both of you sharing, we are rewarded for paying attention. We want incentives that influence paying attention. Like it seems like the theme here for me learning is paying attention. Like I need to pay
Yep.
attention to my finances. I was paying attention when I met Frank in the elevator.
Oh God.
And
How
then
do
I
we get
see
back
this
in?
6'4", like,
Jeez, I've gotten taller.
oh
I've somehow gotten
yeah.
taller.
I see this dude. I'm like, dude, talk to him for 10 minutes. Yeah, he's going places. Now I'm talking to you, Luke. You're awesome. There was a
Luke's like the
question in
same
there
height,
somewhere,
mate.
but
Pretty scary.
I squirreled off. But if you guys could think about that, for next time, I'd love maybe some coaching or we could, because I think from practical sense, our listeners we're all gonna buy, well, hopefully, God willing, buy a house someday, owe somebody a mortgage.
Yep.
I hope all the listeners like
I think,
are thinking about
yeah.
investing in their future and like you know, entertaining the idea of investing in guys like you, or you guys. But anyway, if you want to close it out, Alec, there was a question there somewhere.
Yeah, it's all good. Yeah, I think it's like as Luke touched on earlier, it comes down to the person's personality and emotions too, to see what they want to do. And I kind of think a classic example of it is the Davises and like the Chris's dad. We're gonna have Chris in the podcast in a month or two, but Chris's dad and grandfather just naturally were inclined to more leverage than Chris was. So Chris's grandfather, the his house was never really like it was never fully paid off. He always had debt in his house. He had a big stock portfolio. At some time, he even had a margin loan. And then his dad also the same ideology of not paying off the house and using that money to invest in shares because the house loan was fixed at a lower rate than what he thought he could. He was nearly for his own personal balance, like for his own personal finances. There was the it wasn't a risk-free rate because it was the mortgage, how much the mortgage was taken out from you, like the return that you would need to beat your mortgage. So yeah, obviously the equation made sense for him, and then obviously for Chris doesn't. doesn't play around with debt much and is very defensive. So that's just kind of like through that family, for the generations, you can see it's not even like a change in mindset. I think it just suits everyone's personality better. So for Luke, Luke might want to have more debt than me. I might want to have less debt than him. And it really comes like there's a personal financial circumstances which I cannot provide to anyone, and I don't know anyone's circumstances, and I'm not licensed to provide advice on that. But it's, I think it does come down to your emotions and all the stuff that Luke touched on too. And then, yeah, it really depends. If like some people are just wanting, they'll naturally be more defensive and they'll naturally try not to lose money. And some people will naturally they'll take more risk. And that's just how they're wired. It's like, that's one of my beliefs. So, yeah.
Well, Luke, final word.
Oh, look, I was just sort of absorbing all that. I fully agree. I mean, I think as humans, we naturally are averse to risk taking. It's been ingrained
Yep.
in us for thousands of years that if you take risks, then you're taken out by the lion in the savannah, sort of thing.
Yep.
So for most people, like I said before, when they start the investing journey and a bit more hands-on, it's that first time where the risk of investing and you get slapped in the face by a big drawdown in your portfolio, and as we were sort of joking before about the media headlines, of course, skew very negative, and that's where a lot of people then, that natural instinct to say this is too risky for me, I'm going to take a step back. And that's why I think, the idea of superannuation, IRAs in the States, there's different assets around the world, make a lot of sense because a lot of times that's out of sight, out of mind. So for most people, I've got my investments, they're doing this for me in the background, and that's great. But, I suspect most people who listen to this podcast are probably a bit more, ambitious, financially minded. And so, I encourage those people to sort of, the only way you'll find out about yourself is if you push those boundaries. Maybe start out with an index ETF and sort of, you can track that on your phone and your portfolio, see how you feel for, what do your emotions do when you log on at the end of the day and you see your portfolio's down $2,000? How do you react to that? And you can build up some emotional resilience. And then, maybe you could look at fund managers like myself and others and, get a feel for how we invest, what we do, perhaps invest with a fund manager and take that journey. And then, of course, the one where I encourage people, at some point in their lives is embrace it yourself. Do some work into a business that you might know. You may be a customer of a business that's listed on the S&P 500. And you've got some insight into how that business works. Its outlook for the future. And invest some dollars into ideas like that and get a feel for how these things work and sort of see the tangible the tangible way the market works. When a business performs well, stock performs well, my capital's now, growing and expanding, and then vice versa. And then obviously, this is where Alec and I started. And then, you catch the investing bug and it snowballs into you're looking at every business across an exchange and delving into these unloved areas, unexplored areas, and looking for these small opportunities and I think it's super exciting. But no, all I could say is I encourage people to start the journey and how they do that. There's a lot of different ways, but I think that's the most important step.
Jay,
Your guys,
Berkshire's a classic. Oh,
go
sorry.
ahead.
Berkshire's a classic example in the industry, and everyone always refers to Berkshire and Warren Buffett and Charlie Munger. But like, I'm sure people have lost money on Berkshire, and their emotions have gotten in the way. And like as Luke was saying, like people can lose money on a broad-based index fund if their emotions do get in the way. And yeah, it's amazing that even like arguably the greatest investor of all time, Berkshire's had drawdowns of more than 50% if you go back in history and look, and that can be scary for some people. Yeah,
Mm.
sorry, I'll let you get to your point, Jay.
In closing, I think for this one, we should maybe next time on go deeper on this part. I think we have a nice segue. Is you know, I think Warren and Charlie exemplified something that could be overlooked. You can go at it alone or you can go together.
Yeah.
and having someone to call if you're Warren and say, see this C's shit is overpriced. No, or yeah, quick. But anyway, if you're listening to this podcast, thanks so much. Please go to season 47, episode 557. Listen to our first episode. Look out for much more to come. I hope. Luke Winchester, Merriweather Capital, man. I'm excited. Thanks for coming back.
Thanks for having me, guys.
Man.
Yes, come back soon, and we will all see you next time on the Culture Matters podcast.
Cheers. Thanks.